Okay, so we've been talking about the stock market and all the ups and downs lately, and you had this idea for a deep dive that I think is really timely.
Yeah.
I know it's top of mind for a lot of folks out there right now, how to navigate a correction.
Mm-hmm.
And particularly, I think what you're interested in is how can we maybe look for opportunities to actually make some money through dividends during a downturn.
Yeah, exactly.
So without getting, too deep into all the crazy, complicated financial jargon,
Yeah.
let's see if we can take this material you found and make some sense of it.
Sounds good.
So we've got this article from the Motley Fool.
Right.
And for anyone who's not familiar, just a little bit of background, the Motley Fool's been around for a while, since 93.
A while.
Yeah. So they've kind of seen it, right?
I feel they've been through a few cycles.
They've been through a few cycles, and, they've got their website and all sorts of investment services that they offer, podcasts, even a foundation. So really their whole mission is to make the world smarter, happier, and richer.
I like that, and that's really helpful to know because the source of information is always important.
Absolutely.
And, their longevity suggests they've probably got some pretty seasoned perspectives to share,
Right.
so I'm curious to see what they have to say.
Yeah, so the article talks about a stock market correction, which I think we should probably define.
Sure.
Just so everyone's on the same page.
Yeah, so for folks who aren't, checking the market every day, a correction is basically when the market drops 10% or more from a recent peak. So it's a pullback, but it's often temporary.
Right, and that's the situation the article is looking at specifically as a potential opportunity for dividend investing.
Exactly.
Okay, so we've got a market that's down.
Yeah.
What's the opportunity here for someone who's focused on income?
Well, it all comes down to the relationship between stock prices and dividend yields.
Okay.
So when you have a company that pays a consistent dividend and the price of the stock goes down like it does during a correction, the yield actually goes up because the yield is calculated as that annual dividend payment as a percentage of the stock price.
Right.
So as the price goes down, that percentage gets bigger.
Got it. So it's an inverse relationship.
Exactly.
Interesting. So you're basically getting more bang for your buck in terms of potential income?
Yeah, that's a good way to put it. You're buying these stable dividend-paying companies at a lower price, and because of that, you're locking in a higher initial yield.
I like that. Okay, so the article you sent me highlights a specific way to maybe take advantage of this.
Right.
And that is the Schwab U.S. Dividend Equity ETF.
Yes. Have you heard of it?
I've heard of it. Tell me more.
So its ticker symbol is SCHD. SCHD. And as of March 14th, 2025, the article noted its price was around $27.64.
Okay.
Now, what makes this ETF so interesting is that it gives you exposure to about 100 high-yielding dividend stocks all in one go.
So instead of going out and trying to pick all these individual stocks, it's already kind of done that work for you?
Exactly. You get that diversification within the ETF.
Okay, very cool. So what's the strategy behind SCHD? How does it pick these companies?
So SCHD aims to track the performance of the Dow Jones U.S. Dividend 100 Index.
Okay.
And this index is interesting because it doesn't just look for the absolute highest yielding companies. It targets companies that have a consistent history of paying higher than average dividends.
Right.
And they also need to be in good financial shape compared to their peers.
So there's some quality control built in.
Exactly. They're not just chasing the biggest payouts because sometimes a really high yield can actually be a red flag.
Right. It could be a sign that something's wrong.
Exactly. So they're looking for that balance of attractive yield and a solid financial foundation.
I like that. Okay, so we know SCHD holds about 100 stocks, but the article mentions something about concentration in its top holdings.
Yes.
What does that mean?
So this is an important point. The top 10 holdings in SCHD make up over 40% of the ETF's total investments.
Oh, wow. Okay, so it's not like the investment is spread out evenly across all 100 companies.
Right. A handful of those top holdings have a big influence on the overall performance.
Okay, good to know. And the article actually gives us a prime example of one of those top holdings.
Yes.
AbbVie.
AbbVie. It's a big pharmaceutical company and a good illustration of what we're talking about.
Okay, so what makes AbbVie so special when it comes to dividend investing?
Well, they have an impressive track record when it comes to dividends. Since it was formed back in 2013, they've increased their dividend payment every single year.
Wow.
Every year. And the article highlights that they've seen a 310% growth in their dividend payouts during that time.
310%.
It's remarkable.
That's huge.
It is. And it shows you the potential for growth in your income stream.
Yeah. So what about their current dividend yield? How does that stack up?
So AbbVie is currently offering a 3.1% dividend yield. Now that's more than double the recent yield of the S&P 500, which was around 1.35%.
Wow.
So for every dollar you invest, you're getting more than twice the income from AbbVie compared to the average company in the S&P.
That's a pretty big difference.
It is.
But can they keep paying it?
That's the important question, and the article addresses that too.
Okay.
They talk about AbbVie's financial strength and how they generated $18.8 billion in operating cash flow last year.
Okay.
And that easily covered their $11 billion in dividend payments.
So they can afford it.
They can afford it, and they've got a comfortable cushion to continue those payouts.
That makes me feel better as an investor.
Right. You want that peace of mind.
Absolutely. So it sounds like AbbVie's got a high yield, a history of increasing those payments, and the financial strength to back it up.
They do, and it's not just about the present. The article also points out that AbbVie is expecting strong revenue growth in the future. Yeah, they anticipate high single-digit growth every year through at least 2029.
Okay.
Driven by their products like Skyrizi Rinvoq and their aesthetics business.
So that future growth means they could potentially increase the dividend even more down the line.
Exactly. It's a good sign for continued dividend growth.
Okay, so AbbVie seems like a pretty solid choice for a dividend investor, high current, yield a history of growth, strong financials, good prospects for the future.
Yeah, they seem to be checking all the boxes.
And the article suggests that the other top companies in SCHD are kind of similar.
That's right. They generally offer attractive yields, consistent growth, strong financials, and a positive outlook for the future.
Okay, so we've talked about the companies. Let's go back to the ETF itself.
Sure.
What kind of income are we looking at with SCHD, especially now with the market being down?
So the article says that SCHD's trailing 12-month distribution yield was 3.6%.
Okay.
But because of the correction, the current yield is even higher. It's at 3.8%.
So that lower price actually made the yield go up.
Exactly. And the article gives a really good example to show what this means in terms of actual dollars.
Okay, I like examples.
Yeah, so they say if you invested $100 in SCHD, you'd be looking at about $3.80 in annual dividend income based on that 3.8% yield.
Okay.
But if you put that same $100 into an S&P 500 index fund with its yield of 1.35%, you'd only get about $1.35.
Wow. Okay, so that's a big difference in terms of the income you're getting.
It is, and it highlights that potential benefit of buying during a correction.
So it's not just about the current yield. The article also talks about how SCHD's dividend payments have been increasing over time.
Yes, they mention a chart that shows the growth of their quarterly dividend payments, and since the fund launched in 2012, they've grown by 550%.
550%.
It's pretty impressive.
Yeah, that's a long-term trend of increasing income for investors who have held the fund.
Exactly, and it shows that they're not just paying a decent dividend, they're also committed to growing that dividend over time.
Okay, so to sum it all up, the article says that SCHD is a smart fund to buy right now. What's their reasoning?
Well, they say it's a good choice because it combines several key factors. It invests in high-quality dividend-paying companies with a history of increasing those payouts. Those companies also have strong financials, and because the market is down, the price is lower, so you get a higher starting yield with the potential for future growth.
Okay, so we've covered a lot of ground here.
We have.
This was a really in-depth look at this article from the Motley Fool about investing in a high-yield dividend ETF during a market correction.
Yes, and I think it was a great example of how you can quickly get up to speed on a complex topic.
Right.
And see a real-world application of financial concepts.
Absolutely. And for you, the listener, you're interested in gaining knowledge thoroughly but quickly.
Yeah.
And I think this deep dive really helps you understand how you might navigate these market fluctuations.
Definitely. And having those specific examples like SCHD and AbbVie makes it much easier to grasp the concepts.
Yeah, but this article really focused on just one ETF.
Mm-hmm.
So as we wrap up, I want to leave you with this big. What are some other things beyond just yield and historical growth that you should consider when you're evaluating dividend-focused investments?
That's a great question. You always want to do your due diligence and look beyond just one potential solution.
Right.
So some other important factors to consider would be the ETF's expense ratio.
Okay.
So that's the annual cost of owning the fund. You also want to think about diversification across sectors within the ETF.
So not too much concentration in one industry.
Exactly. You want to spread out the risk.
Okay.
And of course, your own individual risk tolerance and your investment goals should always be the driving force behind your decisions.
Absolutely. SCHD is a great starting point, but there's always more to learn, and you should tailor your choices to your own personal circumstances.
Couldn't agree more.
All right. Thanks for joining me on this deep dive.
My pleasure.
Always great to chat with you.
Likewise.
And to you, the listener, as always, thanks for tuning in to the deep dive.